Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at European real estate and how in particular private markets can offer routes into the sector. And my guest is Alex Murray, Vice President of Research Insights at Preqin. It goes without saying that an extended rate hike cycle has penalised real estate. That, of course, without even mentioning the other body blow to especially offices, the pandemic. But if monetary tightening is reaching its conclusion, could that bring some relief? That has recently been the hope in public markets, where beaten down valuations could be seen as an opportunity. But does the same apply to private markets, where, according to Preqin earlier in the year, a slow fundraising environment was one reason for a swelling number of funds, and where real estate deals have recently suffered a contraction, the sixth quarterly contraction in a row. A drop reflected, says Preqin, in pricing in European real estate investment trusts, now below the trough of the pandemic. Well, joining me now to unpick some of that is Alex Murray, Vice President of Research Insights at Preqin. Welcome, Alex. First of all, let's look at the backdrop and the recent history of real estate, a sector which has been hit by high interest rates, high inflation, and of course the pandemic.
Yeah, I mean, you referenced three big tickets there that have affected the sector. Of course, interest rates are used as a reference to price a lot of these assets, and as that interest rate rises that we've seen come through continue to increase, that depresses valuations. You know, you discount those future cash flows back, and that reduces present values. What I would say, though, of course, though, you've got to think about potential upsides on the inflation front. Can real estate asset owners pass on those inflation rises through the incomes that they charge for their assets, and that will help the cap rates on the numerator side.
Private deals are down. Does this mean that maybe they're hitting a bit of a trough? This is a good time for investors to move in. There are opportunities out there.
It's a difficult time because of those. It's not so much the high interest rates; it's the fact that they've been continually increasing over such a long period now. And that has really slowed the market down, because this spread between what the price sellers want and what buyers are willing to pay has been widening over time. What I would say, though, is that as we come to the end of this credit tightening cycle, as those rate rises moderate and start to tabletop, if you will, start to level out, the floor of the market will rise, and pricing will start to firm up, and you'll see more deals done.
Now, one area of concern has been, of course, commercial real estate, and in particular offices. And in fact, where we're making this programme, we're right next to HSBC and just down the road from Credit Suisse, two big organisations which have been beset by those problems. How do investors prevent themselves getting burdened with what are potentially stranded assets? If
you've got an asset in a good location, there's always those options for refurbishment, to repurpose, maybe towards mixed-use development. But the challenge there is really that higher interest rates on the debt that you'd raise to finance that investment in redevelopment, but also the higher inflation cost just of delivering those construction works. You know, you've got labour costs and material costs; they're all up 30–40% more higher than pre-pandemic, and that makes for a much deeper J curve, and that's much harder to pay off in the same sort of time period that you'd have seen in previous years.
Let's talk about a couple of the strategies which you suggest might be interesting. One being private debt funds, where returns and spreads make things look a bit more attractive than their equity equivalents.
Yeah, it's a really interesting sector. So we did some research across the real estate fund strategies over time, and we looked at the maximum and the minimum target returns for those funds. And as you might expect, so the value added and the opportunistic funds, the ones at the sort of higher end of the risk spectrum within real estate, they were targeting typically between 14% and 18% IRRs over the long run. What was really interesting is, though, when you look at real estate debt funds, they had a much wider spread than the core and the core plus equity funds, so that the upper end of the real estate debt funds were targeting 12%, and that was higher than the upper end than either core or core plus, and that's not what you'd expect from a debt fund per se.
You also mentioned pipe deals. These are deals which target public assets. Tell us a bit more about that.
What's really interesting, though, is the prospect of public to private deals. Of course, we've got over 400 billion of dry powder within global real estate private funds. About 70 billion of that is targeting Europe. That 70 billion is about half the value of the Stoxx European 600 index. And of course, not all of these real estate funds can maybe digest a large take private of a REIT, but some of the larger funds certainly can.
Alex, many thanks for sharing your thoughts today. Alex Murray, Vice President of Research Insights at Preqin. It's great to have you with us.
My pleasure.
And that is your roundup of European real estate. I'm David Pollard, and this is Reuters.